As we head into 2015, the markets are near record highs and the consumer is strong. But what should we expect on the economic and housing fronts in the new year? Let's ask Lawrence Yun, the chief economist with the National Association of Realtors. And Lawrence, we'll talk about the economy in 2015 in just a moment. But first, some disappointing numbers out on Monday morning showing a drop in existing home sales. They fell 6.1% in November, the lowest level in 6 months. What's your reaction to the data?
You are right. It is a disappointment because all the factors for improving home sales are developing. We have more jobs, rising stock market near record highs. The rents are rising, squeezing some of the renters to become homeowners. And still exceptionally low mortgage rates, yet home sales are not clicking. And that could be due to the fewer choices available for buyers. I think they may have essentially taking the enthusiasm out of the housing market.
Now, moving into next year, does this change your outlook on housing? Give us a sense of how we should look at the housing market in 2015.
I think the key variable is new home construction. If we have increased new home construction back to normal, historical normal, which would be about 1.5 million a year, that's compared to only 1 million in 2014, then we would have more inventory. Buyers would be more enthusiastic with more choices. And furthermore, it would tame the home price growth so that affordability does not get out of hand. So assuming all these factors and no recession, I anticipate home sales to rise anywhere from 5 to 8%. Home values rising much more moderately, 3 to 5%. And housing starts, so hopefully you would have a decent, robust growth.
Now, tomorrow we'll have another reading on gross domestic product. Are you expecting some of the past estimates to be revised higher? And how does your GDP outlook look in 2015?
Well, the second and third quarter GDP were outstanding, above 4%. In the fourth quarter figure, the revision figure, there could be very little change because this is the final revision, not the initial estimate and revision. Very little change. I don't think there's any significance in that. I think what is more important is, what we will see in January when we get the first read on the fourth quarter, and it may come into the 2% because of the sluggishness of the housing market recovery.
Let's talk about mortgage rates. We're certainly watching the Fed in 2015 to see when they'll raise short-term interest rates, and that'll raise the cost of doing business for banks. But you're looking at rates on 30-year fixed mortgages to stand at 5.4% by the fourth quarter of next year. Right now, they're just under 4%. So tell us how you came up with that forecast.
Well, the Federal Reserve will certainly be raising their Fed funds rate, the short-term rate, sometime in the middle of next year, best estimate. But the long-term rates, like the mortgage rates, would be rising in anticipation of that. We don't know exactly whether it is going to be March, April, but the long-term investor bond investors will be taking cues from about when the Fed will raise their short-term rates, and hence the mortgage rate will be rising. And another factor is that I believe people are underestimating inflationary pressure. We are seeing low gasoline prices, very good for the country, but the biggest component of the consumer price inflation is apartment rents. And the apartment rents are rising at 3.5%, which is a 7-year high. So if there is any upward reversal in gasoline prices, I think we could have a little higher inflation than most economists or the Federal Reserve expect.
All right, Lawrence Yun, chief economist with the National Association of Realtors, thanks for joining us.
Thank you.
For TheStreet, I'm Scott Gamm in New York.